Hey, what is up? Quick video. There are a couple things to look at. I want to show basically no code in this video, but just some looking at action and kind of stuff around FOMC last week. It's May 12th today, so over the weekend there was, China and US meeting in Switzerland. And the markets reacted favorably, and everything is ripping into this morning. But last week, May 7th, was FOMC, and I noticed some stuff across the curve. Specifically, I'll just jump right into it. In these calendars, so here is June minus September, and what I noticed, this is a daily chart. Basically this was the meeting, and I kind of got the vibe that these spreads were like going down into the meeting, then after the meeting they reverted right back to where they were before. And this one didn't do it exactly. Like, it started reverting off of May 1st, so there was probably like NFP here. There's probably some other hard data. Let me see. What was it? There was GDP or something on the 30th. So maybe this was like GDP and then it reverted. I don't know what the exact cause was, but here's another one where it seemed to me like we're going down into it, then after it goes back the other way. Here it was a little more of an exact bounce. This is December minus March, so slightly further out, slightly more uncertain, but close enough to be relevant. Here, March minus June 2026. And then once you go far enough out, it's like it's, a nothing burger. But I was just looking at that, closer in. And, come to think of it, I guess this M5, this one, it's not going to be moving around so much now, so it really is just the short end ones that are really active, where that might happen. And I was also going to use this as a chance to show kind of how I'm using TradingView to look at this stuff. This is all delayed data. This is on a daily chart, but you can go intraday with this stuff. These are the out rates. Then I do have the implied rates here, so just 100 minus the rate. Pretty trivial. This one is the useful one. If you type in SOFR, you can get this. It's only on the daily chart, unfortunately, but it is basically the effective rate at our point in time. If you get a different series of this, it will be only monthly, so it won't match up to the Fed meetings, unfortunately. And to use that in formulas, you would use it like this: FRED : SOFR. And so you can make a formula out of that like this, minus SR3Z2025, something like this. So now this, oh, I did it wrong. SOFR, yeah, minus 100 minus SR3Z2025. Yeah, okay, now so this is the implied rate change versus the effective rate. So as you saw, this effective rate, it's not, damn, yeah, and it can also come out to this Samsung. This is probably like some, I don't know, income ETF or something. It's pretty, you don't want that in there. This implied rate, like right now, the rate should be like here, the effective rate, but it's going to be bouncing around a little bit, plus or minus a few basis points. Maybe you can use that as an indicator itself. But anyway, it's more or less going to show you the implied amount of rate cuts, and so it's kind of useful when just looking at this, like, hey, we're probably going to get one rate cut now by September. How did this move lately? You know, we were thinking we were going to get 4 rate cuts by September a month ago, and then now we're only going to get 1. Like, for some reason that just makes me laugh. You know, hey, we're going to get 2 by December. Slightly less than 3 instead. Like, it kind of flattens out here. You can see where it flattens out, and then it's like, hey, we get rate cuts up to here, and then nothing, right? And then we're going to start hiking. So that's probably the main thing that kind of simplified how I look at this. The next thing is calendars. That goes along with this. Calendars, it's just one minus the other. So here we have March or June minus September. The number is the relative difference between them. So like, hey, we're going to get 1 cut between June and September, right? Then another between September and December. Then it flattens out, and then we get hikes, but just barely. We don't even know yet. So this was like what I started looking at, because I like looking at spreads, and it's kind of useful. And so when you see the changes in here, you can tell, hey, like the rate cut, it just in the last day from this, you know, over the weekend news, we've shifted out. Like, we thought, you know, like we weren't getting a cut or whatever, or like June is basically already priced in. It's not going to move. It only moved 3 basis points, right, from the weekend news. But this September, that moved 6. So, hang on, that seems really high. Was I looking at the wrong one? Why did this move 27? Huh, this is not making sense to me. M25 minus U25. M25 minus U25. And that isn't making sense to me. You know, minus 3 and minus 6, it seems like the difference between that is minus 3. And then here, I'm looking at it and I'm seeing 27. I'm gonna have to look into that later. Anyway. Yes, the kind of where the cuts are coming along the curve, so, you know, maybe before it was here, and then it shifted to here, or maybe before it was here, and then it shifted to here. This one, it moved... Oh, wait, yeah, okay, so that's the other thing. This number, this is like... I think it's off by a decimal or something, like, you know, here if you see it, minus 0.03, and here minus 0.06. That's basis points. That's 3 basis points, that's 6 basis points. Then here, if you see it, if it's like 0.40, that's 3 basis points. So this is actually like 3 basis points. 0.30 is 3 basis points. I don't know, just something to keep in mind. So yeah, you can look at this and say, hey, okay, this moved 3 basis points and this moved 6. The difference between them is 3. And then this moved 3. But we don't know what moved in what in here. We don't know if it was M staying the same and U going up, M going down and U staying the same. Like, you don't know that, so you kind of look at this to get the picture of, hey, how did the whole curve move? It moved down, because the news was good, like, we're gonna, so we don't need the cuts anymore. You can look at this implied number, to see how it moved. They moved down. We're going to get less cuts. And then you can see this one to see the relative one, kind of where did that come from. Oops. And so actually looking at this, I don't really know. I think the mid curve moved down more and this moved less. So we needed less cuts overall, and I don't know, it seemed like they kind of shifted forward slightly anyway. I'm just thinking about that for a second. Yeah, I can't tell really where shifted from what. I suppose it means that they shifted out, like, you know, hey, we don't need the cuts anymore, so maybe push one cut out the curve, and that could shift the probabilities so that I believe before these probabilities were like a coin flip and they were shrinking to less than a coin flip. I'm saying for, like, you know, U, M and U, or I mean the meetings between these. That's one difficult thing, is that these are quarterly and then the meetings are not quarterly. Anyway, yeah, it seems like it shifted the probabilities and then pushed it out the curve a little bit. So now we have, you know, this 25. This is slightly more than 25, but this has lessened actually. So it's like more certain we're going to get a cut here, and then less certain of anything. Like basically we're going to get one and then nothing else. That's what these two are telling me. And these two, M isn't moving around much, but U and Z are very relevant right now. Okay, so that brings me to the next thing. Which was the first thing I was talking about. Yeah, it looked like, you can't tell from the chart of the outrights so much. But it seemed to me like going into May 7th meeting, right here was just going down the whole way, but then when I was looking at the calendars and the spreads, which is kind of what I look at mostly anyway, with this one it seemed like, hey, we bounced off of May 7th, like went down into it, then up after, down into it, up after, down into it, up after, and then less so as you go out the curve. Is this a normal? This is I'm just looking into this for the first time. Is this a normal thing that happens around other Fed meetings? Because it seems to me like we didn't have any really actionable data going into that, so like why would it move at all apart from the market just being the market? So I'm looking at the calendar on this little, you know, FX factory calendar. We had FOMC before that. Did we have anything before that? Like, no. There was this ISM thing, which, you know, usually doesn't seem very relevant, but, you know, when people are uncertain, the smaller and smaller points of data seem to matter more. Friday the 2nd was NFP, so I guess that kind of is in there. But anyway, I want to look at some other Fed meetings. I'm not going to go through all of them, but just look back at March 19th now. Was that also something? So, you know, you mark this and it's like, okay, it just kind of was sideways, then it went down after March 19th and then up. It rebounded after that. You know, here, hang on, let me zoom in. March 19th here, this one kind of did the opposite thing. It went up, into it, down, and then reverted. So this one just did nothing, or it kind of ticked up, then down. This was the March contract minus June, so like probably not a great one to trade because it's expiring. Yeah, but I brought in these contracts to look at the other ones later. Then going out further into September, you kind of went down into it, then reverted. So to me, it's kind of like, maybe people are hedging or something. I don't know. Then zooming out more to January 29. This one didn't really do anything, so okay. This one didn't do anything either. This one, it dropped before it, then did nothing. March minus June, dropped before it, didn't really do anything on the day, and it makes me wonder if I even had the right day. I don't remember what the vibe was for that one, but I feel like it was like kind of like, hey, beginning of the year, we're not going to do anything, just checking in after the holidays, right? This one, it went down into it and then it reverted quite a bit, but this one was the December, which had, you know, I guess it hadn't started expiring, but it was in that window where your daily rates are actually now kind of, you're getting your real settlement number from what's actually happening. So consider that, you know, December is not moving very much, but March is. So this one, it kind of did, you know, our little thesis where it's like, hey, it moves into it, then it goes away after. It reverts after. Yeah, so it was like a move of like 5 basis points or whatever. Yeah, so I feel like this is highly subjective, depending on kind of how much uncertainty there is, how much, you know, kind of the vibe of the Fed at the time. In the last meeting, there was nothing expected and we got nothing. And then in March, I can't remember, and in January, I can't remember, but I feel like January was nothing as well. I'll go back and look at one more, and then I gotta go, but December 18th, let's look at December 18th. Oh, that's too far back. December 18th. So this one, I guess Z was expiring, or no, September was closing up its window, so like, why would you look at that? December 18, it just went up into it, then spiked even more, and then reverted kind of, so I don't know, I think this is maybe not exactly what we're looking for. December 18th, this is more kind of what I'm imagining, like, hey, it goes up into it and then after it reverts. Actually, it's pretty similar to the other one. This one, yeah, nah. This one, and now we're pretty far out. We're like, yeah, we're like a year out, so not as impactful, but yeah, that's what I'm looking at, and I'm also looking at this, butterfly spreads. You can graph those in TradingView, and I've been obsessed with this one lately. It's just the December ones, Z5 minus Z6, 2x Z6 plus Z7. Yeah, and this one, I've been looking at this on a long term, and I'm just like, hey, how can it do this? Like, oh, imagine if this reverts. Total, like a technical trading kind of mentality, but yeah, so when you go way out, the base case for any of these, if you're way far out, is just 0. Like, hey, we don't know what it's going to do, we don't know what it's going to do, and we don't know what it's going to do, so it's going to be 0 all the way across, right? And these are kind of funky because now you're not just looking at the relative difference, you're looking at the relative difference of relative difference. So I don't want to look at this too much. But basically, this, where is it? Oh yeah, 1 year calendars. Yeah, Z5 to Z6. I guess this is steeper than this. Because it's basically this minus this, or this plus this, either way. Yeah, this one is negative, so it would probably be this minus this. The back one minus the front one. This got very steep lately. And this one got very, I guess you wouldn't say they're both steep, but in opposite directions. So that led this to just be a giant downtrend kind of move, and I'm interested in kind of the reversion of this, which we kind of finally got, but just thanks to this weekend. So kind of idiosyncratic. I don't think it was actually a good idea or anything. But yeah, this FOMC thing, this really was pronounced around this too, so I would even go look into the flies, the butterfly spreads, and look at this. It's probably pretty, depends on what meeting you're looking at, and only relevant for a few contracts out. So actually, if you're looking at this spread across 3 years, it's really just the front December one that's making the impact of this effect that we're thinking of. Anyway, those are just some thoughts for now. Hopefully we'll get back to coding and actually getting to the actual basic model that I've been wanting to show. But anyway, cheers.